Imagine a world where your entire life's savings, the small inheritance from your parents, or the profits from years of hard work, vanish overnight. That's the reality a man named Thomas faced in 1720 London. He wasn't a rich baron or a powerful merchant, he was a modest tailor, dreaming of a better life for his family. Like thousands of others, he had placed all his hopes into one seemingly unstoppable investment, an investment that promised incredible returns and a secure future. But as we'll see, the promise of easy wealth can be a cruel illusion. Our story begins in bustling London, a vibrant hub of trade and innovation in the early 18th century. It was a time of immense change, with new ideas in science, philosophy, and commerce sweeping across Europe. For many, it felt like an era of endless possibility, where fortunes could be made and lives transformed. The city was a melting pot of ambition, where people from all walks of life converged, eager to seize their chance at prosperity. This dynamic atmosphere set the perfect stage for what would become one of history's most infamous financial events. At the heart of this unfolding drama was a company called the South Sea Company, founded in 1711. On the surface, it seemed like a solid, respectable venture. It was granted a monopoly, meaning exclusive rights, to trade with the Spanish colonies in South America. Think of it like being the only airline allowed to fly to a popular holiday destination. This was a potentially lucrative deal, promising vast profits from the rich resources of the New World, things like sugar, tobacco, and even enslaved people, a dark stain on its history we must acknowledge. But the company's real appeal wasn't just about trade, it was entwined with a much bigger problem facing Great Britain, a massive national debt. After years of costly wars, particularly with France and Spain, the British government found itself owing a staggering £30 million. To put that in perspective, this was an astronomical sum, far more than the government could easily repay. This debt was a burden on the economy and a major concern for the nation's stability. Something needed to be done, and the South Sea Company saw an opportunity. In a stroke of what seemed like genius, the South Sea Company proposed a bold solution. They offered to take on £15 million of the national debt themselves. In exchange, the government would pay the company a guaranteed 6% interest on that amount each year, and the company would secure even more trade rights to South America. This meant that individuals who held government debt could exchange it for shares in the South Sea Company. It felt like a win-win. The government reduced its immediate burden, and investors got shares in a company with a supposed golden future. The idea of a monopoly was incredibly powerful. Imagine if only one company could sell you coffee, or provide all the internet service in your country. That company could essentially set its own prices and expect massive profits. The South Sea Company's monopoly on trade with South America was seen in this light. Even though Britain was at war with Spain, making actual trade difficult, the idea of future riches from that exclusive right was enough to ignite the public's imagination. It tapped into a deep-seated human desire for exclusive access and guaranteed success. With the deal struck, the South Sea Company began offering its shares to the public in April 1720. They were priced at £300 each. The response was immediate and overwhelming. People were clamoring to buy, convinced this was their ticket to wealth. Demand was so huge that the offering was significantly oversubscribed, meaning far more people wanted shares than were available. By the end of that very first day, the share price had already jumped to £330. This rapid increase sent a jolt of excitement through London, a clear signal that something extraordinary was happening. News of the South Sea Company's rapid ascent spread like wildfire through London's coffee houses, taverns, and bustling markets. Everyone, it seemed, was talking about it. Stories of early investors making quick fortunes fueled a feverish excitement. People who had initially hesitated now regretted their caution, eager to jump on board before it was too late. This wasn't just about financial speculation, it was a powerful social phenomenon. The buzz created a sense of collective optimism, a shared belief that this opportunity was too good to pass up, making it harder for anyone to resist. It's a common myth that only the super-rich or the ridiculously foolish invested in the South Sea Company. But the truth is far more complex and human. People from all social classes poured their money into it. Wealthy aristocrats and seasoned merchants saw it as a smart move. Clergymen, doctors, and lawyers hoped to secure a comfortable retirement. Even ordinary servants, shopkeepers, and artisans like our tailor, Thomas, invested their meager savings, driven by the dream of escaping hardship and providing for their families. It was truly a nationwide phenomenon. What drove these diverse individuals to invest? It wasn't just greed, it was hope. They weren't just buying shares, they were buying into a dream. For some, it was the dream of retiring early, for others, educating their children, or finally owning a small cottage in the countryside. The South Sea Company promised not just financial returns, but a tangible improvement in their daily lives, a path to upward mobility in a rigid social structure. It represented an escape from the grind, a chance to secure a future free from worry, a powerful draw for anyone. To understand the South Sea bubble, we need to understand human psychology. When an investment starts to rise rapidly, a powerful mix of emotions takes hold. There's irrational exuberance, a fancy term for overwhelming optimism not always backed by facts. People see others getting rich and experience FOMO, or the fear of missing out, pushing them to join in. The rising prices become their own justification. It must be good if everyone is buying it and the price keeps going up. This creates a self-fulfilling prophecy, at least for a while, making the bubble inflate further. As the South Sea Company shares soared, a phenomenon known as bubble mania swept across Britain in the summer of 1720. Seeing the South Sea Company's success, hundreds of new companies sprang up, each promising incredible returns. These were the bubbles. Many were fraudulent, others simply absurd, with no real business plan. It was a gold rush, where anyone with a wild idea could find investors eager to throw money at them. The sheer volume of these new ventures showed how completely gripped the public was by the speculative fever. The level of absurdity reached astonishing heights. Some of these new bubble companies were outright scams. One infamous example was a proposal for carrying on an undertaking of great advantage, but nobody to know what it is. Think about that. People were actually paying money for shares in a company that explicitly stated its purpose was a secret. Other proposals included ventures for importing asses from Spain, or making oil from sunflowers. This was a clear sign that rational thought had been completely abandoned in the pursuit of quick riches. Seeing the chaos, Parliament intervened. In June 1720, they passed the Bubble Act. This law prohibited the formation of new joint stock companies, which are companies owned by shareholders, without a royal charter. The intention was to stop the proliferation of fraudulent, smaller bubbles, believing they were drawing capital away from legitimate ventures. However, in a twist of irony, the act had an unintended consequence. It made the South Sea Company, which did have a royal charter, appear even more legitimate and secure, thus inadvertently fueling its own bubble even further. By June 1720, the South Sea bubble reached its absolute peak. Shares that had started at £100 a year earlier, and £300 just months before, now commanded an astronomical price of £1,050. Imagine seeing your investment multiply more than tenfold in such a short period. This incredible rise fueled an almost hallucinatory sense of invincibility. People felt they couldn't lose. The market had detached itself entirely from any underlying value, driven purely by speculation and the belief that the price would simply keep going up forever. Everyone was a genius, or so they thought. With their paper fortunes skyrocketing, people began to live like kings. The newfound wealth, or at least the illusion of it, led to extravagant spending. Merchants splurged on grand houses, servants bought luxurious clothes, and even our tailor, Thomas, might have dreamed of a bigger workshop or better schooling for his children. Everyone wanted to show off their success, creating a visible spectacle of prosperity. This conspicuous consumption further encouraged others to invest, making the boom feel even more real and permanent to those caught in its intoxicating grip. But this prosperity was largely an illusion. Most of the wealth wasn't real money changing hands, it was paper wealth, the theoretical value of shares on a balance sheet. People felt rich, but they hadn't actually cashed out their profits. They held on to their shares, believing they would continue to rise indefinitely. This is a critical distinction in any bubble. Feeling wealthy is not the same as being wealthy. The moment everyone tries to convert their paper wealth into actual cash, the system often breaks down because there isn't enough real money to go around. Beneath the surface of euphoria, faint whispers of doubt began to emerge. A few cautious voices questioned the fundamentals. How could a company with limited actual trade be worth so much? These were usually ignored, drowned out by the roar of optimism. But some astute investors, often those with deep understanding of finance, started to get nervous. They saw the rapid rise as unsustainable and recognized the market was running purely on emotion. These shrewd individuals began quietly selling off their shares, slowly detaching themselves from the impending crash. As often happens in these situations, those closest to the company, the directors and well-connected politicians, were the first to understand the danger. They knew the true, meager value of the South Sea Company's actual trade. While publicly reassuring everyone that the good times would continue, they were quietly selling their own shares, cashing in their immense paper profits. They were effectively pulling the rug out from under the very people they encouraged to invest. This insider selling, though unnoticed by most at the time, was a critical turning point, signaling the beginning of the end. The summer of 1720 turned into autumn, and with it, the mood shifted dramatically. The peak had been reached in June, but the fall wasn't instantaneous. It was a gradual, agonizing decline that gained momentum in September. As more insiders sold, and fewer new investors arrived to buy, the price began to waver, then drift downward. This slow bleed caused anxiety to turn into worry, then panic. Each drop fueled more selling, creating a vicious cycle. The collective confidence that had built the bubble now began to unravel with terrifying speed. By late September, panic gripped London. People realized the impossible truth: the bubble was bursting. Everyone wanted to sell their shares, but there were no buyers. The market became a stampede, a desperate scramble to get out before losing everything. The emotional contagion that had once fueled the rise now accelerated the collapse. Friends turned on friends, families argued, and a sense of betrayal filled the air. The dreams of easy wealth morphed into a terrifying nightmare, as fortunes disappeared in moments. The fall was swift and brutal. From its dizzying peak of £1,050 in June, South Sea Company shares plummeted to a devastating £150 by September. This wasn't just a slight dip, it was a catastrophic collapse, wiping out years of perceived gains and the life savings of thousands. Many investors, having borrowed heavily to buy shares, now found themselves not only penniless but deeply in debt. The market, which had promised to make everyone rich, had instead delivered widespread ruin, shattering countless lives and changing the economic landscape forever. Remember Thomas, our humble tailor? His dream had become a nightmare. All the money he had diligently saved, every penny he had invested, was gone. The small sum intended to secure his family's future had evaporated. The very next day, his landlord demanded the overdue rent. Thomas had nothing left. The shame and despair were crushing. His story was just one of thousands, each representing a shattered life, a broken promise, and a future stolen. This wasn't just a financial event, it was a deeply personal catastrophe for ordinary people. The human cost of the South Sea bubble was immense. It wasn't just individual investors who suffered, entire families were ruined. Businesses that had depended on the supposed wealth of their customers collapsed. Social structures were shaken as trust eroded. The widespread devastation touched every corner of society, from the highest aristocrat to the humblest servant. For many, it was an unprecedented shock, a collective trauma that lingered for decades. The dreams of many generations were wiped out in a matter of weeks, leaving a profound and lasting scar. The despair that followed was profound. There are accounts of people taking their own lives, unable to face the ruin they had brought upon themselves and their loved ones. Others were committed to debtors' prisons, their freedom stripped away. The emotional toll was immense, far beyond mere financial loss. It was a loss of dignity, hope, and social standing. The glittering promise of the bubble had curdled into a bitter reality, leaving behind a trail of heartbreak and desperation across the nation. This level of human suffering is what truly defines the bubble's impact. In the aftermath, anger and a desperate search for answers erupted. Who was to blame? Fingers pointed everywhere, at the greedy South Sea Company directors, at the politicians who had supported the scheme, and even at the investors themselves for their naivety. The public felt betrayed by those in power and by the institutions they had trusted. This era of widespread distrust and recrimination left deep divisions within society, highlighting how financial crises can shatter not just wealth, but the very fabric of social cohesion and collective belief. In response to the public outcry, Parliament launched a furious investigation. It revealed widespread corruption and fraudulent practices among the South Sea Company's directors and even some members of the government. This was a scandalous discovery, shaking public confidence in institutions to their core. Several prominent figures were implicated, including high-ranking officials. The scale of the deceit was astonishing, showing just how far people would go to profit from the madness, even at the expense of ordinary citizens and national trust. As a measure of justice, though perhaps inadequate, Parliament ordered the seizure of assets from many of the South Sea Company's directors. Some of these individuals, who had grown fabulously rich at the public's expense, were stripped of much of their ill-gotten gains. This punitive action was meant to deter future fraud and offer some symbolic retribution. However, the amounts recovered were a drop in the ocean compared to the billions lost by ordinary investors, and the financial ruin was impossible to fully undo. For many, it felt too little, too late. To alleviate some of the suffering, Parliament did provide a measure of relief to investors. They attempted to redistribute some of the recovered funds and restructure a portion of the South Sea Company's capital. While this offered a glimmer of hope for a few, the aid was minimal compared to the colossal losses. Many people received only a fraction of what they had lost, and for those who had mortgaged everything, it barely made a dent. The government's intervention, though well-intentioned, could not fully restore the fortunes or the shattered lives of the victims. The South Sea bubble left a lasting scar on Britain. It deeply impacted public trust in financial markets and in government. For a generation, cautiousness and cynicism replaced optimism. People became wary of large joint stock companies, and investment in public projects slowed significantly. The memory of the bubble served as a stark warning, a reminder of the dangers of unchecked speculation and the fragility of supposed prosperity. It shaped financial regulations and public attitudes for decades, underscoring its profound historical significance. So, what was truly at stake in the South Sea bubble, beyond the staggering amounts of money? It was trust in institutions, trust in fellow citizens, and trust in the fairness of the economic system. It was about broken dreams and shattered lives, the erosion of social cohesion, and the psychological trauma of betrayal. The bubble exposed the raw vulnerabilities of human nature, greed, hope, and the desperate yearning for a better life. It highlighted how easily a collective delusion can take hold and lead to catastrophic outcomes, fundamentally reshaping countless personal stories. Let's confront a common myth, that only the foolish rich or the incredibly naive were caught in the South Sea bubble. As we've seen, this simply isn't true. Everyone, from aristocrats to humble servants, invested. The allure of easy money is universal, and the human desire for a better life transcends social class. It wasn't about being foolish, it was about being human. It was about hope, herd mentality, and the powerful psychological pull of an opportunity that seemed too good to miss. The bubble reminds us that intelligence offers no immunity to collective delusion. Ultimately, the South Sea bubble stands as one of history's clearest lessons in human psychology and financial markets. It showcases irrational exuberance and the herd mentality in full force. Greed and fear are powerful drivers, often leading people to abandon logic and sound judgment. The desire for quick, easy profits can blind us to obvious risks, especially when everyone around us seems to be getting rich. It's a timeless reminder that while financial instruments change, human behavior, and its impact on markets, often remains strikingly consistent. The South Sea bubble wasn't an isolated incident. History is dotted with similar speculative frenzies, from tulip mania in 17th-century Holland to the dot-com bubble of the late 1990s, and even more recent asset bubbles. The names and technologies change, but the underlying patterns of human behavior, hope, greed, fear, and the belief in "this time it's different," remain remarkably constant. Understanding the South Sea bubble helps us recognize these patterns today, not as ancient curiosities, but as vital warnings embedded in our collective financial memory. One of the most crucial lessons from the South Sea bubble is the importance of due diligence. This simply means doing your homework. Before you invest, truly understand what you're buying, who is behind it, and what its real value might be. Don't just follow the crowd or rely on hype. Ask tough questions, research the fundamentals, and be skeptical of promises that sound too good to be true. If something claims to offer guaranteed, impossibly high returns, it's often a red flag. Your money, and your future, are worth the effort of careful investigation. The bubble also teaches us about risk. Every investment carries some level of risk, the possibility of losing money. The South Sea bubble showed what happens when people forget this fundamental truth and believe an investment is risk-free. It's vital to understand the potential downsides and only invest what you can truly afford to lose. Diversification, spreading your investments across different areas, is a strategy born from such events, designed to reduce the impact if one particular investment collapses. Never put all your eggs in one basket, especially when it's a rapidly inflating bubble. The ultimate takeaway from the South Sea bubble for ordinary people like Thomas is that financial literacy is power. Understanding basic economic principles, how markets work, and recognizing the signs of speculative excess can act as a powerful shield. It's not about predicting every crash, but about being equipped to make informed decisions and resist the allure of get-rich-quick schemes. This knowledge empowers you to protect your hard-earned money and secure your own future, rather than becoming another victim of collective delusion. Despite the immense devastation, the story of the South Sea bubble also carries a message of resilience. People eventually rebuilt their lives, businesses recovered, and London continued to thrive. Humanity has an extraordinary capacity to adapt, learn, and overcome even the most catastrophic setbacks. While individual lives were tragically lost or forever changed, the collective human spirit found a way to endure. This resilience is a testament to our ability to pick up the pieces, learn from our mistakes, and forge ahead, even in the face of profound adversity. So, what can we, ordinary people living today, take from the South Sea bubble? It's a powerful reminder that history offers invaluable lessons, not just about finance, but about human nature itself. By understanding the dreams and despairs of those who lived through it, we gain insight into our own vulnerabilities and strengths. Let Thomas's story not be one of pure tragedy, but a cautionary tale that empowers us. By learning from the past, we can build a more secure future, equipped with knowledge to navigate the unpredictable currents of markets and life. The South Sea bubble serves as a timeless mirror, reflecting the enduring human emotions that drive our decisions, both good and bad. It shows us that financial crises are not just abstract economic events, but deeply human stories of hope, ambition, and vulnerability. By connecting with these narratives, we don't just learn history, we learn about ourselves. Thank you for joining us on this journey into the past. We hope this guide helps you understand this South Sea bubble, not just as a historical event, but as a profound lesson for all of us today.